Good afternoon, everyone. Thank you so much for joining into our Starmark Trustmark Healthy Choice webinar. My name is Deb Wilkinson, and I'm the Vice President of the Health Plan Options Department here at URL. I oversee the under 65 individual health, such as it is in the state of Pennsylvania, as well as the group market for both fully insured and self-insured. I did want to take a little bit of time for those that are new to this format and to the webinar program to let you know how you can maneuver your control panel. You do have a control panel on the right-hand side of your screen. You can ask questions, which will be answered at the end of the webinar by typing in your question into the question box, or you can just raise your hand icon. There's a little hand icon, and you can raise that, and I can unmute you at the end of the webinar to ask your questions. I'm going to introduce Gino Gambardello in a few minutes here, but before that, I'll take a little bit of time for those that are new to URL or that have never heard of URL Insurance Group to tell you a little bit about our organization. I've been here, it will be 22 years in July. It's a great family-run organization. And we have multiple lines. If you want to know about us, you can go to our website, which is urlinsgroup.com, learn a little bit more about us, our carrier partners. We've been in the business over 30 years, and we have different silos, if you will. We have an annuity department that's overseen by Joseph Corio, our Senior VP, all the carriers that we have. Joe also runs webinars, bi-weekly webinars, to track the DOL fiduciary ruling, the best interest of the client ruling that has been delayed till June. So if you want to know more about that, Joe Corio is your guy. Employee benefits that's run by Sam Bohr. This includes all of your group, worksite, voluntary, ancillary type products, and this is a list of our products. Health plan options, we have all of these carriers, short-term, group, individual, life markets, which is overseen by Steve Clemens. And again, a lot of unique and proprietary products within our life markets division, a lot of really interesting, really quick apps. So again, if you're in the life markets, long-term care, I would encourage you to reach out to Steve Clemens. And then last but certainly not least, our Medicare Offerings Department, which does all things Medicare. That's headed up by Christy Wilbert and Karen McDaniel. And of course, they offer the Part Ds and the Medicare Advantage, MedSups, etc. So we really are a full-service wholesale agency. If you want to know more about our department and what we do, you can go to the department. We run a Gemini program, which really is a unique program offered by URL. It is proprietary, and it's for those partners that want to have a stronger relationship with us, and essentially it gives us first right of refusal if we offer the product, and the Gemini partnership has to agree to submit those products through us, that business through us. We do have a Gemini guarantee that you will not be asked to take cut-in commissions. If we can't match it or if we allow you, if you will, to go outside the Gemini. So with the Gemini, there are a lot of bonuses, and that includes group health bonuses. I paid to our top group health groups $300 last year as part of our group bonus for specific to Gemini, which is awesome. So again, there's a lot of resources within our homepage, a lot of information. The webinars that we do are all recorded, including this one. You will be getting a link with the recording, but if you want to go to our homepage, you can see the YouTube icon up here. You can click on that, and you can see an entire list of our webinars that we run daily. So again, this is here for you. We certainly hope that you find all of these things helpful. So I'm going to stop talking and hand over the controls to Gino Gambardello. He is the sales consultant for Trustmark and Starmark. He's in the Trevose, PA area. If you've not talked with Gino or had him help you strategize over groups, he's a great wealth of knowledge, certainly knows these products, always willing to strategize with you and get that client the best approach that the two heads or three heads can put together. So without further ado, I will hand it over to you, Gino, and thank you so much for doing this today.
Okay, thank you, Deb. Appreciate that. So thank you, everyone, for joining us this afternoon on the webinar. I wanted to kind of go over a quick agenda list with you. This is really a new product that's kind of on the forefront of what you're seeing out there, perhaps, in healthcare and insurance products. So I'll start with an overview of this particular product. I'll go through the benefit design, what reasonable fee levels actually mean, product availability, pricing, the underwriting guidelines, balanced bill protection, which is a key element and feature of this particular product, provider negotiations, and some marketing communication information, which I'm sure Deb will probably follow up with as well. So the Healthy Choice product is basically a reference-based pricing item. And for you that may not be familiar, reference-based pricing is basically a pricing model that's based on a multiple of Medicare. So this is basically in the wake of the whole industry trying to grab a hold of this cloak of secrecy surrounding provider networks pricing, the huge variances in different costs from, for different providers. So what this is attempting to do with reference-based pricing is to kind of force the industry to come to some reasonable conclusion as to what health costs should be. So that certainly is appealing to a lot of people, and I'm certain that probably many of you that's very attractive to. That's why you're joining here. So we'll get into some of the points as to why this is the case, and so you'll see some of the benefits of reference-based pricing that it has. So from there, you may ask, well, what's driving this? Well, because of this, again, new enterprise and what's happening with healthcare, we took a survey of a variety of many brokers, and the feedback was very positive. They wanted to, see products like this. Again, it's something that's been mentioned. People are becoming more and more aware of it. So for us, of course, we did, see an opportunity there as a sales opportunity, and we decided to go for it. Starmark has a unique position in this product space right now. There are a couple of other providers that are doing this sort of thing as pioneers, just as we are. It is a low-cost alternative, and I'll talk about how those costs may differ in different parts of the country. And the key point for our particular area is, in addition to some cost advantages that it might have over some of the other two networks, it also, the big thing for us, I think, is the freedom of provider choice. And that could be a very, very overwhelming and compelling sales feature for some groups in some areas. So with that, I'll move on to the next slide. Again, this product has no network. This is, again, reference-based pricing, so the employee or the person can go to any provider that he wishes. There is no, now sometimes people have a hard time, wrapping their head around that. But as this becomes more prevalent, this will be a fair and common practice, as you will see, over the next few years, we imagine. So the other big thing about this particular product is it's a multiple of Medicare, and the other feature that we're offering with this product is, unlike some indemnity plans, and although this is not quite an indemnity plan, you may want to look at it that way for now, there's no responsibility for the members to pay any balance bill. So should that happen for a provider, we will take care of it, and I'll go through in later slides how we actually handle that process. So, but that will be a key feature and key selling point for this product as well. So we'll go through some pricing advantages of the product against Healthy Edge and the other product that we have. And the effective date is 5/1/17, which of course is, we've done quotes already for 5/1, so it's all up and running, ready to go for you folks. So the benefit design for this product, again, is similar to the Healthy Edge and the other products that we have. The only thing difference is that for specialty drugs, they have to use a specialty provider, and we've designated CVS specialty pharmacy for that particular purpose. And there's also for organ transplants, we've specified only a certain, I think it's the Optum Center of Excellence transplant facilities throughout the country. So besides those two exceptions for other medical provisions and doctor visits, they can go anywhere they want. The one thing I want to also point out to you that's part of this product is we're all familiar with Teladoc and some of these other things you may not be familiar with, but one thing you may not be familiar with, and that's something called Healthcare Blue Book. So the Healthcare Blue Book, again, comes with the product. It's free, and it's actually a service that the employees can log on to and actually do a logical research on their particular provider and see exactly what their outcomes are like and their cost. So obviously across the spectrum of all the providers, you got really bad doctors charging a whole lot of money, and you have the opposite as true as well. So with the Healthcare Blue Book, you can go in there and really find, the best guy for the buck as you possibly can. And with a reference-based pricing model, that dual capability is very powerful. So again, I point that out. That is part of the product, and really adds to the compelling force of the reference-based pricing model. So the reasonable fees that is paid through this model, again, this is based on an analysis of prevailing cost, and they compare it to what the Medicare, Medicaid costs are. And with that, they establish what's called a reasonable price for a particular service. Not customary and reasonable. You won't see the word customary in here because customary is what's been the problem. It's going to be a reasonable cost. So for most states, we're going to pay 150% for physicians, 175% for facilities, and then for medical equipment and injectable therapies as noted there. The only 4 states that are exceptions to this are Alaska, Montana, Wyoming, and Wisconsin. In those cases, we're going to pay 250%. So they're the only exceptions. So if any of you folks have, groups outside the PA area that you, may be able to promote or, find this of value to other clients, then certainly it's pretty much the same across the country. So the 4 basic considerations for the rate development here is basically the benefit design, the difference in provider reimbursement, the balance bill frequency, and we'll get into that as well, and some other expenses, including administrative cost and compensation. Regarding the kind of discounts, you can see 75% of these plan designs and 75% of the market zip codes will offer a 5% or more compared to our other lowest cost network option, either Cigna or Aetna. And then as much as 50% of those zip codes will have cheaper price of 10% or more. So there's definitely a cost advantage in most of every zip code in the U.S. There are maybe a couple where it's actually not, it's equal or at parity or maybe even slightly higher. In Pennsylvania, I think the ranges are from 3% to as high as 13%. I remember seeing one zip code with a discount lowered by about 13 percentage points. So as far as the underwriting guidelines and what we can do with this product, it's basically a standalone product, but we can couple this as a dual plan option with one of the other standard products, which is the HSA qualified plan or our CDHP plan. So we can do that as long as it's the Aetna network or one of the other networks, which we don't really use too much. So you can have a dual plan design using this reference-based pricing product, and with that, you can have an HDHP plan using the Aetna network. And that can make for a pretty powerful sales strategy as well in certain kinds of groups, and we can get into some of those details as perhaps down the road we start looking at new groups that may have some interest in this product. So one thing, Healthy Choice cannot be paired with Healthy Edge, any PPO plan. So we can pair it only with the HSA qualified plan, not the standard PPO plan that has the copays and whatnot. So again, that's not going to be anything of a big issue, simply because people that are going to be interested in this product will do so only simply on the merits of the fact that it's, it's reference-based and there's no network provider. It's free choice. So the balance bill protection is, again, one of the key aspects of this product. Just with a couple caveats, the balance bill is not going to cover any member out-of-pocket expense, and it must be a covered expense. And the members are not responsible for the provider charges above the reasonable fee. So if, for example, somebody, and I'll have examples of this in a few slides, but if you go to a doctor or a provider and they're not going to accept whatever the 175% of Medicare is, they will balance bill the employee. Now, typically under those scenarios, I think I've gotten a couple of balance bills in my lifetime. They're not a fun thing to look at. So, but with this product, it certainly gives people peace of mind because we will try to negotiate those balance bills with the provider all the way up to whatever they're expecting. And that's not the responsibility of the employee. It just comes out of the plan. So that is, in my viewpoint, one of the most attractive aspects of this product because it does two things. While it provides the employee complete choice and freedom of what doctor he wants to go to, it also protects him from the fear of being balance billed. The dreadful balance bill is eliminated. The ID card is as shown. It does show the providers, what the payment will be, 150% for physicians and 175% for Medicare. Here's an example of how the balance bill scenario could work. So you go to an urgent care facility. The urgent care charges $300. The reasonable fee for this urgent care, according to 175% of Medicare, is $200. And so the amount over is $100. The member's copay is $50, so he still pays that. And the plan from the self-funded plan, we pay them $150 for the $200. The provider is not happy. He comes back to us, and instead of giving him the extra 100, we give him an extra 50. So in total, between the 200 that's paid by the plan and the 50 by from the copay, he's getting 250. So that's how that scenario would pan out. So again, it may not have been 50. The guy could have accepted the amount as is, or he could have wanted the entire balance bill, forwarded to him. Either way, we're covering the employee. Here's another example of a major medical scenario. Hospital coverage is $70,000. The reasonable fee is $50. The amount over is $20,000. The member's responsibility is $5,000. So we're going to pay the provider $45,000. He's not happy. He wants an extra $20,000. We bring it down to $10,000. At the end of the day, we negotiate and wind up paying him the $10,000 for a total of $55,000. Plus the $5,000 from the deductible, which gives him the employer or the provider a total of $60,000. So again, another scenario. So this is just to highlight some things that could happen. The most important thing, probably with this kind of product, as valuable and as attractive as it could be to many groups, it's just important for them to understand when you're doing your initial meetings or maybe the follow-up meetings going forward with the enrollment and the group being issued. It's basically to explain to the employees of the possible balance bill scenarios and not to panic, and it's a pretty simple process to take care of them, as I will outline for you very shortly here. So there's going to be a reasonable fee reduction explanation on the EOB, and the EOB explanation code says charge exceeds reasonable fee, see plan documents for details, and should that appear on the EOB, the employee simply calls Starmark, and then we take it from there. And here's a sample of that EOB, and here's where it says the allowed amount, and here's where it says the other adjustment. So with that example of the urgent care, here's that other adjustment of $100 that we're not going to pay under the reasonable fee doctrine, if you will. We're not paying that, and this is what we're going to pay. So should the employee then get balance bill because of the COB and the provider sends him that bill, then he simply calls Starmark, and then we go into our negotiation process, and I'll show you what that looks like shortly. So the pre-treatment for this kind of plan. No, some of you are probably thinking, well, what happens if a provider doesn't even accept this? They look at the card and they look at you like you're from Mars. From what Clear Health Strategies tells us, there's really only about 1% or less of providers that would outright reject a plan. So if the provider tells the employee they're not going to accept the plan, employee notifies Starmark, we contact Clear Health. Clear Health then contacts the provider, and then if the provider then really, after understanding what's going on, they decide to say, okay, that's fine. We get back to Starmark, who notifies the employee. If they, for some reason, say they fail to negotiate, there's no payment level agreement, then Clear Health notifies Starmark, we notify the member, and under those scenarios, I guess he's got to find another doctor. So that's how this whole thing works with pre-treatment negotiations. Like I said before, statistically, so far from what Clear Health tells us, that's only 1% or less of providers may reject that. As far as the post-treatment, where there could be a balanced bill, if there is a balanced bill, again, provider submits claim to Starmark, we process it, provider balance bills the member, yes, and then once the member gets that balance bill, again, he sends it to us, we take, we contact the, and by the way, this, from the time Clear Health, our partner, gets that balance bill, it takes roughly 7 to 10 days to come to some outcome. So once it's negotiated, Clear Health notifies Starmark, and then we notify, Starmark issues a new EOB, and then we're done. So that's really the process. It's not really that long. It doesn't really take that long. So if you add another maybe 2 to 4 days for the rest of the cycle to take hold in terms of getting hold and sending letting Starmark know, then once we know, we can advise Clear Health, and then it takes about 7 to 10 days, maybe another day to get back to the employee. So roughly you're talking maybe 10 to 14 days for the whole cycle to pan out. Okay, so the marketing resources for this are, so far, I think we only have 2 brochures. There's, I think Deb either has or will be sending them to you. Basically, they're a Healthy Choice Advantages flyer, which is really cool and kind of starts to spread the word about how good of a product this could be, not only for from the perspective of what it could do for a particular individual or a company and wanting that free choice, but also in terms of advancing the mindset of changing the way healthcare and networks work and these outrageous variances between providers. So the more providers buy into this, the more I think we can see level pricing and more reasonable pricing and a more consistent pricing increases in healthcare in general. So the plan design brochure, the Healthy Choice top advantages is what we have. I think Deb will have those for you, and we'll have other stuff coming out shortly. As we do, I will disseminate that information to Deb in URL, and she could forward them accordingly. Let's see, and then there's, of course, we have other additional resources. We also, as you probably know, these are readily accessible. Just make your request through URL. We have plenty of marketing tools for brokers to promote the self-funded product, to promote, why Starmark is great. This one particular product, in fact, 10 reasons why brokers choose self-funding with Starmark. And that's an interesting piece. Maybe you guys can take a look at that at some point. But we do consider ourselves the leader in self-funded for a variety of reasons, probably pointed out by this flyer. So if any of you have not been working with Starmark and URL, maybe a good education piece for you all. So with all that, Deb, I think that's it. If you have any questions popping up, then we're ready to go with those.
All right. Well, if anyone has any questions that they want to ask out loud, just raise your hand icon, and I will, at this point, look at questions. Oh, it looks like we have a lot. Just as an FYI, I do have attached to this control panel that you can pull up and print the Healthy Choices brochure that Gino was showing you, as well as the advantages of reference-based pricing flyer. In addition to that, I do have our URL 17 Tools flyer to let you know, for those of you that aren't familiar, the services and benefits that we offer and you receive by doing your group business through URL, as well as a consumer-directed value ads. You can, pardon me, advertise our value ads to you as your value ads to your clients. So the consumer-directed value ads flyer can also be made to reflect your agency, your picture, etc. So those are all attached. So let's see. Oh, it looks like we had some. Oh, we definitely had some audio issues. Hopefully that's been taken care of. Nancy says, how many providers will refuse to accept the insurance because of problems with not being paid what they are expecting and to charge the employee the full amount at time of service?
So that's probably a very unlikely scenario, as I may have mentioned in the presentation. Probably about 1% will reject the whole concept. The other statistics are if they do say, if the mindset is they will submit it, maybe they're a little bit leery about what the payment might be, even though it does say it on the ID card, then they can, of course, balance bill. The statistics, again, these vary depending on zip code, but right now it looks like maybe 3% or so, again, depending on the plan design, the provider, the zip code, because it's not exact across all states, but right now it looks like statistically at a high level, 3% approximately may decide to balance bill the employee, just to give you some reference point.
All right, and Jennifer says, how does negotiation work for a simple sick office visit? Does this plan have to follow ACA preventive care guidelines?
Absolutely, yes. Preventive care are all part of it. They're all ACA compliant. So if whatever the cost reimbursement based on the 150% of Medicare is for a typical routine preventive care is not satisfactory to that particular provider, and he chooses to balance bill, then we either negotiate it or we pay him whatever he asks out of the plan. So it would be covered.
And the doc visit would be handled as any other copay.
Exactly, just like, exactly. So if the copay, for example, is $30, but just hypothetically, the actual cost for that particular physician for an office visit, let's say, is $130. So the employee pays the $30. He sends his $100 bill into us. We say what's reasonable according to Medicare is $75. And if he chooses to balance bill for the $25, then he can. The odds are very much against that happening. So don't, but if it does, again, the employee's reassurance is that he is not going to be responsible for anything. Once he pays his copay at the doctor's office, he's done.
Okay. Tim says, on average, how much of a premium savings to a comparable PPO plan? That's going to be a tough one to answer.
Yeah, so if you compare our any particular PPO plan that we have two basic products, Healthy Edge and Healthy Incentives, depending on, in Pennsylvania it's called Healthy Edge. If you compare it against that PPO plan, which uses sometimes the Aetna network or the Cigna, depending on which is the lowest cost, if you compare this plan to those, our lowest cost network plan, PPO, standard PPO, in most places, it's going to be a little less. In some states, it's as much as 20 to 25% less. In the Pennsylvania area, this plan could range from 3% to 13% less than the PPO plan.
Okay. Nate asks how small the group has to be if it goes down to a small group, and the answer is 5. This product still goes down to 5, correct?
Absolutely, yep. Just like the other product, it goes down. We can go down to 5 enrolled lives, correct.
And just like any other self-funded or level-funded plan, it is medically underwritten.
Yes, it is.
What is the average size of, Sarah asks, what's the average size of group that this product appeals to? Is it suitable for groups under 50?
Absolutely. Yes, it is.
Okay. I think it probably am making an assumption that it's going to appeal to the same groups that, the PPO product appeals to, the healthy groups, the ones that trend well as far as claims.
Yeah. So basically, to elaborate on your point, Deb, thank you for interjecting that. So yeah. So really, this is the same target market as our other two products, and our sweet spot for group sizes is 20 to 50, 60. So it's right there in that range. So I think it's very appealable to those groups. So if groups that not only maybe are looking to, I mean, today every penny counts. So in addition to the potential cost savings, although it may be as little as 3 or 4 or 5%, I think the possibility, because I've talked with groups and brokers where there's sometimes their employees are kind of frustrated with their networks. They don't, they're frustrated because their doctor that they want to go to is not in them. There may even be a scenario where there's these specialty doctors that don't even belong to any network. So this is kind of an interesting concept. This was just talked about, I think, a little bit earlier today. And so these kind of boutique providers or doctors that, only take a special clientele that pay through the nose, could possibly someone use those? Under this scenario, they could. I mean, we could, you could go to someone like that, with them having the full understanding of what could happen, then they could, send in their bill and not be happy with the payment, and of course then balance bill us and not even be amenable to any kind of negotiations, and we wind up paying the rest of what he wanted or she wanted from the plan. So there's a lot of different options and scenarios in terms of how this thing, plays out in real-time markets. It is a new concept for many people. So I think that, of course, will always be something that folks consider when presenting. Some folks are more aggressive. I mean, I got some brokers now that are really pushing this hard, just to give some options, and some groups still are probably going to come up against groups that are going to actually look for this kind of plan where there's no networks. You basically can go wherever you want. So, but our sweet spot's 20 to 60 or so, and it fits right in there in that sweet spot.
And it does go down to 5, Scott's asking. And yep. Richard asks if the client will ever pay more than the copay amount or the out-of-pocket max listed on the policy.
No. Nope. The client, so I think I may have went over this quickly, but so the anything beyond his copay or his deductible, so he's still responsible for the deductible, of course, and the copay. So once that's been met, right, anything beyond that's provided toward the payment of the provider in excess of the reasonable fee of 100, and depending on provider or facility or doctor, anything beyond that is paid from the plan. So the employee or the patient is never going to be responsible for any of that balance bill. That's just the way it works. They are not going to be responsible for it. And
another Richard has a number of questions. It is a self-funded model. It's not fully insured, no matter what program, the PPO or the reference-based healthy choice product. And it is medically underwritten, so they do have the ability to rate up. So it's not, I mean, it is guaranteed issue, but they could rate up. Mm-hmm. Correct?
Yeah, so I mean, the whole premise of our self-funded plan for small groups is still the same. The premise is that small groups, right, instead of going to the traditional market where over the last few years, especially since the Affordable Care Act has kicked in, where basically the risk factor for rating insurance has gone away. That's why rates have skyrocketed. What self-funded does for small groups is give them the ability to attain health coverage based on the merits of their health status. So that has never changed. That's still the premise of our product. And with that said, the only way to accomplish that and to assess the risk is to do a medical questionnaire. We make it easy. We can do it online, we can do it by phone. There's no paper apps required. So the premise for the product hasn't changed, and this is to provide groups with a really viable option of low-cost coverage based on the health status of their group, and with the potential of actually getting some kind of rebate or refund based on how the claims run. So that's not any different than it was.
Right. I mean, think about an insurance world where you have a product that does not need to adhere to all of the mandates of the Affordable Care Act, and you don't have to be locked into any one network, any one provider, and there's no balance billing, and you get the rate appropriate to the health of your group. You know, those are all the things that people are really searching for, whether you're a group or individual. Those are the things that we as Americans are all searching for, and this product, I really feel, has it all wrapped up in one. Now, is it right for everyone? Absolutely not, but it's right for the right type of group, and I think it's exciting and innovative. So
well said. Thank you.
Thank you. Richard has another question, and he says, please review again what happens if the provider does not accept the plan, the payment.
Okay, the payment. So he's accepted the plan, but he's got his payment. He's not happy with it, right? That's the clarification point.
Right.
Okay.
Yeah.
So what happens then? They will send a balance bill to the patient, the employee. When the employee gets that balance bill, okay, he simply calls the number Starmark, sends them or emails them or faxes it to them, maybe the balance bill, and then we take it from there. So that balance bill goes to our partner, Clear Health Strategies. They contact the provider, arrive at some conclusion, and whether it's we make them happy with what they got or give them the entire balance, we do it, and then we send out a new EOB with the updated payment information.
All right, Jennifer's asking a question. Minimum enrollment is 5. It is set up like a level-funded ASO. What is the minimum spec, specific?
For Pennsylvania, it's $10,000.
Okay. And Nancy says, we have a lot of questions here, Gino. Does the amount paid from the plan affect the employer's refund on the level-funded plan or increases at renewal? That's a really good question.
I'm sorry, I didn't catch all that. Could you repeat that, please?
Sure. Does the amount paid from the plan affect the employer's refund on a level-funded plan or increases at renewal? So essentially, if the provider doesn't want to accept that rate and the employer takes that on, it would affect the refund.
Yeah, so absolutely. So any balance bill accommodations are paid from the plan. So if the plan has funds still remaining in the claims bucket, then it just comes from there, like any other payment. If we've already reached the aggregate attachment point and we've utilized all the plan's funds and now it's stop loss is kicking in, then it's paid by stop loss insurance. So whatever scenario, whether it's being paid from the claims bucket because there's still plenty of dollars available, or whether because on a specific level or an aggregate level, we've reached that limit, then the stop loss insurance kicks in and we pay from there. So with that said, whatever the condition was, it's still going to have an impact on how the renewal rate might turn out. So, but how the monies are used to pay out for a condition that's balance billed, that's always going to be paid from the plan, as I just outlined.
Right. And Joe asks how that will affect the renewal rate if Starmark pays more than anticipated imbalance billing charges. That will have an effect on their renewal, as you just mentioned, correct?
Yes.
And Tammy asks,
but before
sure.
Let me just backtrack. So how that what the actual impact could be is it remains to be seen. I mean, this is our first month we've introduced this. So how they my response is basically based on my own, kind of an assessment and intuitive, interpretation of how this could work. But it really remains to be seen as to if there's a lot of providers that are balance billing and we have to give up more funds, then maybe that will impact the renewal rate. How much that's going to take place, I don't know. So again, I just want to leave that open because I don't want to say for sure it's going to increase it, a lot, a little, or maybe not at all. I don't think it's going to be not at all, but I can't say it's going to be very much either. So we'll have to kind of see how that pans out.
Okay. And Tammy asks what the current physician hospital participation in Central PA is like. I mean, have you had, obviously it's just new to the
Right.
streets in Pennsylvania for 5/1. Maybe you don't have enough.
Don't have enough information yet. Yeah, don't have any, right. We've quoted this, several times already now, but we don't have any real life scenarios where people, especially being a May 1st effective date, theoretically, we haven't even been able to test it in any places in Pennsylvania as of yet, because it's just effective date hasn't even hit yet, so.
However, this model has been tested in Pennsylvania, but just with much larger groups. Brady asked the question, and hopefully it was answered, the extra funding from balance billing comes from the employer. The reference that's used to determine it says what reference is used for determining what is a medically necessary treatment, same as your other products, correct?
Yes, that is correct. Yes, yeah. Whatever's medically necessary is still defined as it has been for the other products, and that's what the insurance coverage is based on. If it's medically necessary, then we cover it. That has not changed.
And minimum 5 enrollees, Nancy. Not a 5-person group with 2 enrolling. You have to have at least 5 enrolling. Jennifer says, how are renewals rated? We talked a little bit about that. Are the small groups pooled together for the rates?
No, they are not. There's no pooling for amongst different groups. The rates are solely based on the demographics and the actual medical status of the group that we're quoting.
Well, and that's great because my agent partners out there, you can probably recognize pretty quickly that if this group is going to stand on their own, if it's a group with a bunch of 60-year-old females, it's probably not the right group to introduce this.
Exactly.
Nate says he's confused about the network, and there's no network on the Healthy Choice program, Nate, but the PPO products that Starmark, Trustmark offers have a choice between the Aetna or the Cigna network, so that's the difference. And Gino was mentioning you can have a dual option. You can have this Healthy Choice, no network, reference-based product and have a qualified HSA PPO program as a dual option, a buy-up, if you will.
Right.
Yes, they are medically underwritten, and the group cannot be denied. And can you show that the negotiations is cheaper than a standard PPO discount?
I'm not sure I understand that question, but I can run for any particular group and zip code. I can run a plan design using either Aetna or Cigna, and I can run the same exact plan design using the reference-based model. And I've done that several times already. I've provided some quotes so that they can see, and you can see that the ones that I've done so far, I think the difference was in the 3 to 5% range. So I'm not sure I've answered the question, but maybe I didn't hear it correctly.
Yeah, so I see what she's saying. Mm-hmm. She's asking if when they go to the physician and the negotiated prices are paid, if they end up being less than like a standard PPO discount price. But I guess that could be all over the board as well.
Yeah, right. That could be so the amount that we pay, okay, based on 175% of Medicare for a facility, 150 for a physician, that could be something that provider might be a little bit less than what they're getting under the PPO network provisions. It could be about the same, but whatever the case may be, if the case or the scenario is that it's a lot less than maybe that they were used to getting under their other PPO contracts, then that's maybe it's somewhere a case where that particular provider may decide to balance bill. The thing about this whole balance bill type of product, and where we're going with reference-based pricing is kind of like to try to help move the entire mindset of where healthcare stands, so that providers that are buying more into reference-based pricing, right, are seeing the light, and as they get more customers, it's going to force other providers, right, to actually also adapt similar models, so that we can eventually get to some steady state conclusion as to, or some steady state level where, pricing for medical services is reasonable. The term customary may, we're not using it because it's, customary can be all over the place, and that's part of the problem. So this is like, we're now in a movement of everybody wants to go green, now where we're all, worried about pollution. Everybody wants to make everything recyclable. So this is the go green thing for healthcare. That's what we're talking about, right?
I agree. All right, so there are a lot of questions, and I'm just going to rattle them off. We have about 10 minutes left so that we don't hold everyone too long. Keep it to an hour. So, so this is price to sell. Is it a 12-12 with the option to buy run out? Is it a 12-15?
Okay, great question. So these are typically, for the most part, most of the contracts that we quote now are 12-27 contracts, 12 months of medical service plus an additional 15 months of run out.
Okay. And is there a set admin fee, and if so, what is the dollar amount?
The admin fee, the administrative fee, as you may all know, the premium is broken down into three parts: the admin cost, the stop loss portion, and the claim pre-funding. So those three bucket ratios can differ, from plan to plan design, depending on, how the plans are designed. But for all intents and purposes, you can say it's 1/3, 1/3, 1/3, although it's not really like that. But it all depends on the plan design. The claim pre-funding amount sometimes could be probably more than the other. That might be a little bit more than 1/3, and the admin and stop loss could be slightly less than a third. So it just depends on the plan design.
Okay, so no set fee for sure.
Right.
If they're coming from another carrier with no run out, is there a run-in available to purchase?
No. No, there's not.
No, okay. What is the individual specific set at? Is there an aggregate specific?
The ag for Pennsylvania, again, I think the ag is 15, I want to say. I don't recall, but there is a limit on the ag as a minimum.
Okay. There will be medical underwriting. Will groups receive monthly reporting? They have that through their portal, correct? That they can see how they're trending.
Yes, that's correct. Yeah.
Let me see here. You administer the stop loss. Starmark, Trustmark does, correct?
That is correct. Yep. We stop loss. The stop loss carrier is, just to kind of give a quick overview. So we have the Starmark is the TPA. Trustmark Life, our parent company, is the stop loss carrier, and then we rent the network, either Aetna, Cigna, or now, of course, we use this reference-based pricing model. So that's how the triad works for the products.
And if they do leave after a year, they do forfeit any excess money in that claims bucket. That's typical with all self-funded carriers.
Yeah, but we do have options, though. There are options that we provide. The lowest cost option is a 50% credit if they renew with us. However, we also have options where if they don't renew, they can get 2/3 cash back or 100% cash back. So we have various options, and I think we're probably the only one that have so many surplus options available to the group. They're all a little bit different price range. So from that 50% option to the 100% cash back, there's probably around a 4 to 5% differential in those rates for those kinds of plan options. But so we leave it up to the group and the broker. Typically, I start as the default. Recently, I've been just using the 50% credit, and sometimes a group or a broker will say, yeah, let's change that to 100%. So,
okay, so definitely a lot of options.
Yes,
that definitely affect your rates. So that's something you have to weigh out. Is it worth doing the 100% refund and paying more?
Right. Right.
Jeff says, when you say paid by the plan, since it's self-funded, doesn't mean that the employer is paying the charge, yes, that does mean that for the balance billing. Will you regard an employee who purchases an individual plan via the ACA or exchange count as a legitimate waiver? I believe that is,
Yes.
the waivers
Yes.
are waived.
Yep. Yep.
Says, so in a 60-member group, do all 60 employees need to answer medical questions? Yes, they do.
Just with
Commission.
one caveat to that, though, Deb, real quick. So of
Sure.
the 60 people, if they're all enrolling, then yes. But if there are people that in that group that are waiting because they have spousal coverage or own parents plan, then we just need them to register a waiver. That's all. We just have to have an accountant.
Well, yeah, definitely good point. Sorry about that.
Yeah, that's okay.
Alex says, what is the commission? And that really varies, Alex. You know, it's a percentage, and it's double digit. It goes, you know, on average about 13 to 15-ish. So, you know, and that it's built into the rate. So again, if you want to be competitive, that can come down. If you want to, if the rates are already competitive and you want to keep it high, then again, that's you name the commission, in other words. Brady says, does this take the place of a typical insurance plan, or does it work in addition to a plan like Healthcare Blue Book? I don't know if I understand that question.
Yeah, I'm not sure I do either.
It is, I mean, it's considered insurance. It's going to satisfy the employer responsibilities for the 50 plus. It satisfies the individual mandate. You know, individuals have qualified coverage. The Healthcare Blue Book is really just a tool to use to look for those price transparencies and do better shopping. And what is the run-out term? Can additional terminal liability be purchased? Jennifer asks.
The terminal liability, not sure what the question means. There's nothing. Their only terminal liability is, as far as our plans go, is if, for example, under the 100% cash back option, in the 16th month of the plan, we do a surplus determination where we take a look to see what funds are left over in the claims bucket, and let's say there's you know, $50,000 left in the claims bucket. So based on the fact that we're doing this determination in the 16th month, there could be some other claims still coming in. So we do actuarial analysis based on our block of business nationwide to see, you know, what the probabilities might be that we might see some additional claims coming in. So instead of the $50,000 going back to the group as a refund, we might only give them $45,000 back. So that's the terminal liability that this product really has any reference to. So I'm not sure when you say, can you buy, you know, additional terminal liability, I'm not sure I'm understanding that in the context of how this plan works.
Jen, if you want to email me more specifics, I can get those to Gino and we can get that answered offline. I have two more questions, and I think they're definitely both important for everyone to hear. How does end of the year reporting 1094, 1095 work for the self-funded employers in Starmark? And does it go back to the employer as their responsibility?
Yes, so that's a great question. The 1095B reporting is the responsibility of the group. Now, with that said, we provide them all the details of the information that they need to populate those 1095Bs and then 1095Cs, the cover page, to send to the government, either electronically or by mail. So yes, that we provide them the information, but they have to generate the forms themselves. Now, with that said, it's such an easy process. A lot of times, if the group, they can either do it themselves. If they have a payroll company, they'll be glad to do it for them. If they have a tax accountant, he should know how to do it. And the worst case scenario, or actually not a worst case scenario, but there are many companies now that are doing this. They can, for $2 to $4 a person, they'll actually generate the 1095Bs, mail them to the employees, and also generate the 1095Bs and the cover 1095C cover and send it electronically as a filing to the government. So it's a very cheap thing to do. I know in the traditional carrier guys, I think they generate those for the employees, but for self-funded, that becomes incumbent upon the employer to do that. But we make it very easy for them.
Absolutely. And we have Ben admin systems within URL that does that as well. So with the combination of what Trustmark and Starmark does, you know, certainly there's a lot of outlets to help you with that. Last question before we close up. Jennifer asks, are there set plan designs and can you do an HSA plan with the reference-based pricing plan?
Yeah, great question, and yes, you can. So that's I'm glad that's a good ending question. So yes, we can have the reference-based pricing plan, and then we can have and it's got to be the Aetna network though. We can have an HSA qualified plan as a dual option together for a group as well. So yes.
Okay, good to know.
Yeah.
All right, well that brings us to the end of the questions. I thank everyone so much for joining in. Just as a reminder, you're going to have the recording sent to you, so you're going to get that and you can review it. And then also the flyers that are attached to this webinar. Please take advantage of those. If you need additional information, just reach out to us. We'll absolutely be able to help you with that. And if you need quotes, get them in. Get those censuses in, and your new business specialist can help you with that. Gino, thank you so much for running this for us. And, you know, I can't say enough about how excited I am to see how this product really pans out in Pennsylvania. I think it's innovative and very exciting.
Well, thank you very much, and we are as well. And thank you, everyone, for your attendance and participation today. We really appreciate it. Thanks again.
Thanks so much, everyone. Bye.
Bye-bye.